gold never actually circulates as money. And it hasn't really done since medieval times. It's credit which circulates, and people just don't understand this. So you have got to have some exposure to credit, but just make sure that you've protected yourself against the events which we've been discussing in this video. They are going to happen, and I think they're going to happen really in the not too distant future. Things move a lot more quickly today than they did in the 1920s. In the 1920s, you bought things with cash, and then barrelloads of cash when cash lost its purchasing power. People wouldn't take checks from your bank account because it took 3 days to clear. And in 3 days, what happens to the value of that check? It just goes down with everything else. Well, if you don't hold gold, and I suppose also silver, there are other things. In this sort of catastrophe, actually having the means of producing your own food actually does become rather important. Living in cities puts you at a great disadvantage because the distribution of the basics which we need, particularly food, that's going to break down. Who with, sort of producing, whether it's vegetables or meat or whatever, is going to want to sell stuff into cities for people who can't afford to buy it? Well, sorry, cattle, you're going to live a bit longer, sort of thing. That is a real trouble. If you have credit, you'll get wiped out. It's as simple as that. Think what 4 trillion marks were, if you like. It was some figure like, I can't remember, but I think before the war, the total money in circulation was measured in sort of, I think it was measured in billions of marks, of Reichsmarks, not trillions. Even possibly millions, but it was a very, very low figure. So, if you've got unbacked fiat dollars, they're not going to buy you a cup of tea at the end of the day. On the other hand, if you've got gold, you can cash that in for worthless dollars, which you'll spend extremely quickly before they become even more worthless. That was the lesson really of that experience. And not only that, but if you do have gold, and particularly if you've got legal tender, it varies, the laws vary from country to country, but if you've got legal tender, then you can presumably use your gold to buy real estate, for example, or buy farmland, or nice country estates, or a hideaway away from anywhere, which might insulate you from trouble.
Germany's 1923 hyperinflation is a stark reminder of how quickly money can lose meaning. Before the First World War, the Reichsmark had measurable strength. Within years, it took trillions to buy a single dollar. Savings evaporated, pensions collapsed, and middle-class families found themselves destitute. Yet those who held gold or foreign currency could buy land, estates, and assets at bargain prices. The divide between those who prepared and those who did not was life-altering. The broader lesson? When fiat collapses, real assets outlive paper promises, and political upheaval often follows financial destruction.
But this is a very, very serious issue. It's going to be very damaging for virtually everybody because, let's face it, very few people actually have gold or have gold in any sort of meaningful way. We haven't even touched on problems that follow. If we pursue the analogy with Germany, of course, the complete collapse of the currency and the economy in 1923 led to political instability. It led actually to Nazism, Hitler, and all the rest of it, and World War II. So the idea that this is just going to get the whole thing out of get it out of the system, and then we can get on with lives. And it's not that simple. It really is not. So you're going to continue to be very wary about the situation following what is now looking like going to be a great inflation yet again, a collapse of the currencies, fiat currencies. And the thing that is actually very worrying is I can't see how any politician in the West has the mandate to actually address the problem. And it's in that context we should be more sympathetic about the problems that the German political class felt or faced back in the early 1920s. I'm sure, and if you read into it, you will find that there were people who knew what they were doing. They knew that what they were doing was wrong, but they basically had no alternative. That was the way of it. Well, I've tried to get a mantra going, get out of credit. I know it's not easy, and that you can't get out of credit totally because...
Fast forward to today, and the warning signs are uncomfortably familiar. Inflation has already eroded purchasing power across the globe, while public debt climbs beyond sustainable levels. Bond markets are flashing danger as investors demand higher yields to offset risk. Unlike the 1920s, transactions are now instant and digital, but the fragility remains. Central banks promise deposit security and market stability, yet their tools rely on issuing ever more credit, ironically the very fuel of the crisis. The stage is set for a tipping point where trust in currencies could collapse far faster than in past eras.
Gold never actually circulates as money, and it hasn't really done since medieval times. It's credit which circulates, and people just don't understand this. So you have got to have some exposure to credit, but just make sure that you've protected yourself against the events which we've been discussing in this video. They are going to happen, and I think they're going to happen really in the not too distant future. Things move a lot more quickly today than they did in the 1920s. In the 1920s, you bought things with cash, and then barrelloads of cash when cash lost its purchasing power. People wouldn't take checks from your bank account because it took 3 days to clear. And in 3 days, what happens to the value of that check? It just goes down with everything else. And nowadays, of course, payments are instant. It's electronic. So you don't quite have the same problems that we had at that time. Technology is advanced, obviously, from a banking point of view. Then you've got to consider whether your bank is safe. We know that Feds turned around and the Treasuries turned around and said, we will absolutely make certain that the banking system retains its integrity. We will not let banks fail. A failing bank will always be bought out and depositors will be protected. And they have to do that because the FDIC protection isn't enough, actually. It's a small part of the total liability. So, there are all sorts of things to think about. The main point, I think, is to understand what is going on and to have some gold. And that's why I've set up my Substack, to basically educate people who are not necessarily in the finance sector to really understand what's going on. Because you go to the finance sector and try and get advice on the future, and you will always get the same thing from people who themselves are totally ignorant of what's going on, what is happening to currency. They think currency is money, which it isn't. It's credit. It's just another form of credit. It's the highest form of credit. But when that goes, everything else goes. And, I can tell you that when I started doing this, 10 years ago, I came up with, understanding the way things were going. And I'm sorry to say I've been mainly correct. I haven't always been correct, mainly correct. Timing may be a bit ahead of events. People dismiss me as a conspiracy theorist. Every time I go and speak in the City of London, I find that there are fewer and fewer people in the audience who see me as a conspiracy theorist. So, they're beginning to think a bit more in the direction which I'm going. They haven't bought into it. If you go to them for advice, you won't get that advice, apart from anything else. They're educated by the government not to give the sort of advice, if you like, which you would get from someone who really does understand what's happening. And incidentally, we don't give investment advice. We just try and tell it as it is. So that's why I set up the Substack, and I'm glad to say that it's grown really quite rapidly. You get the full service if you go paid, which is what, a couple of Starbucks once a month, which I don't think is a major sacrifice. The more the merrier. And I just want to get the word out. I want people to understand what's going on so they can make their own decisions, which affects their future and the future of their families and those close to them in their communities.
Modern economies run on credit, not cash. Governments, corporations, and households are entangled in layers of borrowing that can never fully unwind. Gold does not circulate as money anymore, but it remains the ultimate hedge against this fragile system. Those relying solely on credit markets risk being wiped out in a downturn as margin calls and foreclosures cascade through the economy. History shows that bubbles end when ordinary people chasing easy profits enter the stock market en masse. The illusion of endless gains fuels the collapse, and credit evaporates just when it is most desperately needed.
We'll be saying to you, look, it's a dead cert. The market's always going up. We can't stay out of it, so we're going to borrow in order to buy more stock. I mean, we're going to make lots and lots of money. Isn't it wonderful? Yeah, of course that's going on. But that again is, we see this sort of thing at the top of every bubble. People who really don't know what they're doing, getting involved in stocks. Why? Because they're going up and they will always go up. As I say, the valuation disparity is now at record levels. It is frightening. It really is frightening. So that's sort of where we are. Now, you asked about the comparison with Germany between 1920 and 23. Well, between the end of the First World War, which was November 1918, and 1920, there was a significant fall in the purchasing power of the Reichsmark. Call it inflation, if you like, which I think is actually a sort of bad description. But anyway, there's a big fall in the purchasing power of the Reichsmark. But then, and this sort of fits in, if you like, with the war on our economies by shutting down everything during COVID. That was the equivalent of 1918, if you like, as far as Germany was concerned. The economy was completely shattered, and we had to recover. And there was an inflationary outcome. We saw this with inflation running up and peaking in, I think it was 2022. In that case, it peaked in 1920, 102 years before. Interestingly, from that point, there was a boom. And not only that, but the mark was the best performing currency in the world. I mean, it was an extraordinary situation, financial boom. And the stock market rose 300% between the beginning of, I think, around about February 2020 and December 1921. Everybody was doing exactly what we're doing now, what you described, mom and pop, getting into the market, buying it, becoming wealthy, partying, etc. But meanwhile, of course, the laboring classes who didn't have access, if you like, to the stock market to improve their position.
Inflationary booms often create illusions of prosperity. After World War I, Germany enjoyed a brief economic surge. Stocks soared, wages rose, and optimism spread. But the prosperity was hollow, built on cheap credit and money printing. When confidence cracked, the currency spiraled into worthlessness. Today's parallels are striking. After the pandemic shutdowns, global markets experienced a similar surge, with asset prices soaring while inequality widened. If history rhymes, the next phase could be severe: rapid inflation, followed by political and social unrest. A currency crisis does not just destroy savings, it can destabilize entire nations.
They weren't doing nearly so well. They really weren't. There was employment, but not enough really to spread, if you like, the benefits of a booming economy from sort of, if you like, from the very wealthy all the way down the pile. But then what happened was that on December the 1st, 2022, 2021, the stock market peaked. And then, I think in that December, it fell something like 25%. And that marked the beginning of a next phase of what was happening. And that was a new downward acceleration in the purchasing power of the Reichsmark. And it was from that point that it started falling. It was from that point that, if you like, government printing of the Reichsmark accelerated because things weren't going well. You had the credit implosion happening. So what did they do? They increased the amount of government credit to counteract the contraction of private sector credit. And the result was a collapse in prices. The collapse in prices continued right up to November 1923. And by 1923, one Reichsmark, which before the First World War was worth 23 US cents, was finally fixed, if you like, at roughly 4 trillion to the dollar. From 23 cents to 4 trillion to the dollar in November 2023. Complete collapse of the currency. Everybody was wiped out. I mean, except the really wealthy speculators. The Hugo Stinnes, who was known as the inflation king. There's a guy, one of the Thiessens was again a similar situation. Fritz Thyssen it was. You had a few of these guys who really knew how to play the inflation game. And basically the inflation game then was very simple, and it's not available to us today, by the way. And that was for Germany to export to America. Those exports earned gold-backed dollars, which compared with the declining currency, the collapsing currency, was obviously a tremendous benefit for the industrialist. And not only that, but his manufacturing costs were declining because of the collapse in the Reichsmark. And indeed, the industrialists like Stinnes and Thyssen were very much against any attempt to try and stop the hyperinflation. I mean, they were winning from it big time.
The lesson across centuries is clear. When trust in paper money dies, only real assets endure. Gold, silver, land, and productive resources hold value beyond government promises. Policymakers may pledge stability, but their survival depends on printing more credit, accelerating the cycle they claim to control. No politician will risk deflation when the alternative is short-term relief. This is why preparing ahead matters. Safeguarding family wealth means diversifying beyond fiat. Understanding the nature of money, credit versus real value, helps navigate what lies ahead. The timeline may differ, but the outcome echoes history. Those with foresight endure the storm.
And, if you were in that position where you were earning dollars, you could buy almost anything. Oh, no, I've quoted, I think, on your channel before, the situation where, $100 could buy a 6-bedroom house in the swanky part of Berlin, which literally 2 years before had been really incredibly wealthy. I mean, when you think about the effects of the boom, it's rather like booming stock market. So what does that do to Manhattan apartment prices? Oh, exactly. So you can see, the collapse then in terms of dollars, measured in dollars, was almost total. As I say, $100, you could get something fantastic. Mind you, $100 was a hell of a lot of trillions of worthless Reichsmarks. But the lesson there is quite simple, and that is that under these circumstances, you get out of credit and get into real money, which obviously is only gold physical gold without counterparty risk. But the lesson in all this is something which I don't think I've seen written before, and that is that we are actually, I know things rhyme rather than actually sort of replicate exactly, but we are seeing something very, very similar to what happened in Germany currently between 1920 and 1922. That's the current phase. It was preceded by something very, very similar from 1918 to 1920 in terms of the purchasing power of the currency. Will we embark on that last phase? Well, I think the answer is that if I'm right about bond yields rising at the long end, long bond yields rising, effectively a buyer's strike, people no longer wanting to buy government debt because of the whole thing's going wrong. That is going to break the stock market. It'll mean that banks start foreclosing on loans. And particularly, I mean, you mentioned, people who've gone out and borrowed on margin and all the rest of it. To cover those margin payments, they will be sold out into an unwilling market. And what does the Fed then do? Well, I mean, the answer is that the Fed has set itself up, and the Treasury, if you like, has set itself up to be the buyer of last resort for everything. So what's it going to do? Well, the answer is it's going to try and stop a complete collapse in the economy, which means that it'll basically crash the currency. So that's what you're going to get. I can see how it's going to play that third phase that we saw in Germany between 1922 and 23. I can see that's ahead of us. And of course, what happens to the dollar also dictates what happens to the rest of us. Whether we've got a debt trap or whatever, it actually becomes a bit irrelevant.